This week, gold traders around the world watched something rare happen. Gold, the metal that usually rises when war and fear spread, actually fell, and oil, the fuel that usually calms down when tensions ease, shot higher instead. To understand why, viewers need to go back to where this story really began, the Strait of Hormuz. The Strait of Hormuz is a narrow stretch of water between Iran and the Arabian Peninsula. It may be small on a map, but it carries a huge share of the world's oil. For months, tension between the United States and Iran has built up around this passage. Early this week, that tension turned into action. Reports confirmed that Iran's forces struck a commercial ship near the strait. In response, the United States carried out fresh military strikes on Iranian targets. Iran answered back with retaliatory attacks on U.S. positions in the region. Within days, the conflict escalated further. The United States revoked the license that had allowed Iran to sell crude oil and reimposed sanctions that had been eased earlier. President Trump told reporters that the U.S. would either reach a deal with Iran or, in his words, finish the job. For a moment, it looked like the region was sliding back toward full-blown war. Oil markets reacted immediately. Crude oil prices surged more than 5% in just a few days, with Brent crude jumping to its highest level since late June. That kind of sudden spike doesn't just affect drivers at the gas pump. It ripples through the entire economy because oil sits at the center of almost everything: transport, manufacturing, and food production. When oil rises quickly, so do fears about inflation. Now, here is where the story becomes surprising. In the past, this kind of Middle East danger would usually send investors running toward gold, since gold is seen as a safe place to protect wealth during uncertain times. But this time, gold actually slipped. It dropped to around $4,100 an ounce, marking a decline of roughly 1.5% over the week. Why did gold fall instead of rise? The answer lies in interest rates. Rising oil prices raise fears that inflation will stay high for longer. And when inflation looks sticky, investors expect the Federal Reserve to respond by raising interest rates rather than cutting them. Higher interest rates make bonds and savings accounts more attractive, since they pay investors more just for holding cash. Gold, on the other hand, pays no interest at all. So when rate hike expectations grow, gold often loses some of its shine, even during a crisis. By Wednesday, gold had lost about 1.5% of its value. But the story didn't stop there. On Thursday, something shifted. As the US dollar weakened slightly and strikes between the two nations slowed down, gold managed to recover a large part of its losses, climbing back above $4,100. Silver moved even more sharply, jumping over 3% in a single day, as physical buyers stepped in to take advantage of the lower prices. This back and forth is not unusual for gold. It shows a market caught between two competing forces: fear of war on one side and fear of higher interest rates on the other. Investors are left trying to judge which force will win out in the days ahead. By Friday, gold had steadied just above $4,100, and markets turned their attention toward what comes next. Officials from both nations were reported to be continuing behind-the-scenes talks, even as strikes continued on the ground. For now, gold sits in a delicate balance, caught between geopolitical danger and economic caution. To understand where gold goes from here, viewers need to understand the calendar, because in the coming days, a handful of official reports will carry more weight than almost anything else happening in the world right now. The first and most important is the Consumer Price Index, known simply as CPI. It arrives on July 14th, and it measures how fast prices are rising across the American economy. Economists are expecting a modest monthly increase, following a stronger jump the month before. But here is the part that matters most to gold traders. It is not just the number itself, it is what the number suggests about the future. If inflation comes in hotter than expected, it would confirm the fear that has been building since oil prices spiked. It would tell the Federal Reserve that the recent surge in energy costs is spilling over into the broader economy, not just fading away on its own. That kind of result would strengthen the case for an interest rate hike. And history shows that rate hikes tend to weigh heavily on gold, since the metal offers no interest income of its own. On the other hand, if inflation comes in cooler than expected, it would suggest that the recent oil shock has not yet spread into consumer prices. That outcome could ease pressure on the Federal Reserve and potentially open the door for gold to recover further. The day after CPI, on July 15th, two more reports follow closely behind: the Producer Price Index, which tracks the cost of goods before they reach consumers, and the Federal Reserve's Beige Book, a detailed summary of economic conditions across the country. Together, these reports paint a fuller picture of whether inflation pressure is building or fading. Then comes the biggest date of all. The Federal Open Market Committee, the group responsible for setting U.S. interest rates, meets on July 28th and 29th. As of now, market pricing tools show that traders see roughly a coin flip chance of a rate hike at that meeting, with some estimates placing the odds near 60%. That uncertainty alone is enough to keep gold traders on edge, because a single surprise in the data could shift those odds dramatically in either direction. While all eyes are on interest rates, another quieter force has been working steadily in the background, one that rarely makes headlines, but matters enormously for gold's long-term direction. Central banks around the world, particularly in China and Poland, have continued buying gold month after month. China's central bank alone extended its buying streak to 20 consecutive months, purchasing roughly 15 tons of gold in June, its largest monthly addition in years. This kind of buying is different from the fast-moving trades made by everyday investors. Central banks are not trying to profit from short-term price swings. They are building long-term reserves, often as a way to reduce their reliance on the US dollar and protect themselves against future uncertainty. Analysts widely view this steady buying as a kind of floor beneath the gold market, a reason prices have avoided falling too far, even during difficult weeks like this one. Officials have also been speaking publicly about the situation. New York Fed President John Williams recently noted that among the many forces pushing inflation higher, he is closely watching demand linked to artificial intelligence investment, a factor few viewers would expect to connect to gold prices, yet one more piece of a very complicated puzzle. So, as the week unfolds, gold sits at the center of three powerful forces pulling in different directions: a volatile Middle East, an uncertain Federal Reserve, and steady central bank demand working quietly underneath it all. Numbers on a screen may seem distant from daily life, but the tug of war happening in the gold market right now reaches much further than most people realize. It touches paychecks, savings accounts, retirement plans, and even the price of everyday goods on store shelves. Start with the most direct impact: inflation. When oil prices rise sharply, as they have this week, the cost of moving goods around the world rises with them. Trucks, ships, and planes all run on fuel, and that cost eventually gets passed down to consumers. Groceries, electronics, clothing, almost everything that travels through a supply chain can become slightly more expensive. For families already managing tight budgets, even a small rise in everyday costs can add real pressure over time. Then there is the interest rate side of the story, which affects people in a different but equally powerful way. If the Federal Reserve does raise interest rates in response to inflation, borrowing money becomes more expensive across the board. Mortgages, car loans, and credit card rates could all climb higher. For someone hoping to buy a home this year, a rate hike could mean a noticeably larger monthly payment for the exact same house. On the flip side, savers with money sitting in bank accounts could see slightly better returns, since higher rates often mean higher interest on savings and certificates of deposit. This is where gold enters the picture for everyday people, not just professional traders. Many people view gold as a form of protection, a way to preserve the value of their savings when currencies and markets feel unstable. When gold prices swing as sharply as they have this week, it directly affects retirement accounts, pension funds, and investment portfolios that include gold as part of their holdings. A retiree who allocated a portion of their savings into gold may have felt uneasy watching prices dip midweek, only to feel some relief as prices recovered by Friday. Beyond personal finances, there are broader economic consequences to consider. Central banks, especially in nations like China and Poland, have been steadily increasing their gold reserves for reasons that go beyond simple investment. Analysts suggest this reflects a desire among some countries to reduce their dependence on the US dollar in global trade and reserves. Whether or not that shift continues could shape the global financial system for years to come, influencing everything from currency values to international trade relationships. There is also a political dimension to this story that cannot be ignored. The ongoing tension between the United States and Iran is not just a financial matter, it is a human one. Military strikes carry real consequences for the people living in the region, and diplomatic efforts to reach a resolution remain delicate and uncertain. Markets often talk about geopolitical risk in cold, technical terms, but behind every headline about strikes and retaliation are real communities affected by instability. It is worth noting that experts remain divided on where things go from here. Some analysts believe that if diplomatic talks between the two nations continue to make progress, the geopolitical risk premium currently built into oil and gold prices could fade, potentially easing inflation concerns and calming markets. Others caution that the region remains highly unpredictable, and any renewed escalation could send oil prices sharply higher once again, keeping inflation stubborn and interest rate pressure alive. This is the balancing act facing policymakers, investors, and everyday families all at once. A resolution in the Middle East could ease inflation fears, but might also reduce the safe haven appeal that has supported gold. A continued rate hike could tame inflation, but might slow economic growth and make borrowing more difficult for ordinary people. There is no single outcome that benefits everyone equally, and that is precisely what makes this moment so important to watch closely. As this story unfolds, viewers are left with a question worth thinking about tonight. If prices at the pump rise again next week and inflation numbers come in hotter than expected, how might that change the choices families make about spending and saving? And on the other side, If diplomatic talks between the United States and Iran move forward peacefully, would that be enough to ease the pressure building across markets? These are not simple questions, and there is no single right answer. Viewers are encouraged to share their own thoughts in the comments below, because different perspectives often reveal angles that a single analysis might miss. Looking ahead, several key moments will shape the next chapter of this story. The Consumer Price Index report on July 14th stands as the most immediate test. A cooler than expected number could ease fears and support a further recovery in gold, while a hotter number could reignite concerns about a rate hike. The following day brings the Producer Price Index and the Federal Reserve's Beige Book, both offering additional clues about the direction of the economy. Then, later in the month, the Federal Reserve's policy meeting on July 28th and 29th will deliver the decision markets have been waiting for. Whether officials choose to raise rates, hold steady, or signal a new direction, that decision will likely set the tone for gold, oil, and the broader economy for weeks to come. Beyond these scheduled events, developments in the Middle East remain difficult to predict. Diplomatic talks are reportedly continuing even as tensions persist on the ground. Any sign of a lasting resolution could shift market sentiment quickly, just as any sign of renewed conflict could do the same in the opposite direction. This is why staying informed rather than reacting to a single headline matters so much in moments like this. For viewers wanting to stay ahead of these developments, a few simple habits can help. Keeping an eye on official economic releases rather than relying only on social media reactions tends to provide a clearer picture of what is actually happening. Watching how gold, oil, and the US dollar move together rather than looking at any one of them alone often reveals more about the bigger picture than any single number can on its own. And perhaps most importantly, avoiding sudden decisions based on short-term price swings tends to serve long-term financial goals far better than reacting emotionally to daily headlines. It is also worth remembering that markets like gold have moved through uncertain periods many times before. Prices rise, prices fall, and rarely does either movement happen in a straight line. What matters most for everyday investors and savers is not predicting every twist, but understanding the forces at play well enough to make thoughtful, informed decisions. As this week draws to a close, gold sits at a crossroads, caught between fear and caution, between safety and interest rates, between a fragile peace and a fragile economy. What happens next will not be decided by any single event, but by how all of these forces interact in the days ahead. Gold and Crest Finance will continue following this story closely, bringing viewers clear and balanced updates as new information becomes available. Markets may feel unpredictable at times, but staying informed remains one of the most powerful tools any viewer can hold. Thank you for spending this time with Gold and Crest Finance tonight. Whatever direction gold takes next, one thing remains certain. Knowledge and patience will always outlast panic. Until next time, take care and stay informed.